Hey guys, welcome back to the channel Let's Make a Mill, where I'm basically using this channel to document my journey towards making $1 million. And I do this by investing into real estate, investing in the stock market, investing into REITs, which are real estate investment trusts, and real estate syndication deals. In today's video, I'm going to go over how my portfolio of REITs did against the Vanguard real estate index, as well as against the S&P 500 index over the last year. So just for anyone who's watching this and to speed everybody up, the whole idea of this real estate income trust portfolio is to build passive income with specifically selected quality REITs. All right, so I'm not just buying VNQ, which is Vanguard's real estate index, and then just, doing these videos. I decided to take a little more active role in this portfolio, and I wanted to select, quality REITs that, I've researched myself or that I'm interested in to getting exposure to, like things like multifamily apartments, single family homes, cell towers, triple net lease companies, industrial companies, or industrial REITs, I should say, things like that. So I designed this portfolio and then constructed it as a market cap weighted type of index. So basically, the companies or the REITs with the highest market cap are at the top, or the sector is at the top, and then it goes all the way down to the bottom. So this is generally how indexes are constructed. So like the S&P 500 index is constructed in this way, and so is the VNQ or Vanguard real estate index. It's also constructed in this similar manner. So now that the background's out of the way, let's get into how the portfolio did in the last year. So today is January 5th, and so I'm 5 days late. But Happy New Year to everybody else, and hope everyone had great holidays, and I hope everyone crushes it in 2022. But let's get into this portfolio. So I have a current value of $50,768. That is with a gain, which includes a market gain, so capital appreciation on the shares, as well as dividends reinvested. Gain of $12,787. And I have a total return for the year of 48.78%. All right. So we'll just quickly take a look at how the portfolio is. And for those who may ask, this portfolio returns a dividend annual yield of about 2.45%, I think, the last time I checked it. So dividends do fluctuate from time to time because either they do their payouts or, companies are raising their dividends. I keep saying companies, I mean REITs. REITs are raising their dividends, so on and so forth. So let's take a quick look at how I am doing overall in each of the subsectors. So I have infrastructure REITs, which are basically your cell towers, with 5G coming out and everyone's on a mobile device, internet being more prevalent, or mobile device is becoming more prevalent in everyday life. I invested in cell towers. So in those two holdings, I have AMT and CCI. AMT is American Tower, and then CCI is Crown Castle International. Industrial REITs, it looks like of course they're doing well. They do leases of big warehouses. You think of like Amazon, so Amazon needs to lease a warehouse so they can do the distribution centers. That's what an industrial REIT is. Apartment REITs, we all know what those are. It's just, multifamily apartments, it is what it is, I guess. It's just an apartment. Triple net lease REITs, these are REITs that purchase spaces and then lease space out to tenants. So think of maybe a restaurant, like Cheesecake Factory. They need a building, they're going to get it on a triple net lease probably. Think of like a gym, like a Bally Total Fitness, if they even exist anymore, or maybe a Planet Fitness. They're not gonna buy the building outright. They will lease it from a REIT or a company. Then you have your storage REITs, which you buy stuff personally, and then you run out of space at home, so you go to a storage company to put it there. So some of the bigger names in there is Extra Space, EXR, PSA Public Storage, and then you have Cube. Cube Smart, I think, is what their full company name is. Stock ticker Cube. All right. Then we have strip centers. Again, they're doing really well. When COVID initially came out in 2020, strip centers were one of the hardest hit, along with malls. and hotels and leisure and airlines, everything like that. But in the real estate sector, strip centers were hit pretty hard. So think of like large complexes of restaurants, movie theaters, retail. Some apartments are in there, things like that. These large centers. So a lot of them had to get shut down because of COVID. So they were in, the shares were pretty depressed through much of 2020 and then into 2021 as the economy began opening up, as people were getting vaccinated, as things were returning to a new normal. Strip centers just almost skyrocketed up. So I was happy to buy in when I did, and they've been doing pretty well ever since. Then you have manufactured housing, which is your mobile home parks. Two of the bigger names in there is ELS, Equity Lifestyle, and SUI, Sun Communities. Both are terrific REITs. I mean, they've delivered superior returns over the last 10 years, and I mean, they're just going to keep crushing it. Then you have data center REITs. So think of like Netflix, Hulu, Amazon streaming or Amazon Prime, Disney. So when the pandemic happened in early of 2020, when everything in the real estate sector was going down, data center REITs actually performed pretty well. And that's because everyone was staying at home. Everyone was streaming, Disney, Hulu, Netflix. They saw their subscriber base, jump up quite a bit. Then you have all, Microsoft and Microsoft and Sony, they have their networks that provide gaming services. So, they need to lease data center space. So I did have DLR, Digital Realty, I think. Yeah, DLR. And then I had Cyrus One or Cone. And Cone recently is going through a merger and acquisition. So their stock ticker is going to go away. I forget who they got sold to at this moment, but they got sold to another company that's not listed on the stock exchange. So exited Cone and then just rolled all that money back into DLR. So then we run into our single family homes. And if you have not been hearing about the news in the last 6 months, inflation is running high. Real estate prices are going through the roof. Interest rates have been at all-time lows. Single family homes have been on a huge tear up. They've just been doing fantastic. So I'm invested in Invitation Homes. I like Invitation Homes. I invested with them before. The other competitor is American Homes. I think American Homes for Rent. That's another one. But anyways, I invested with INVH. Then we have two new sectors that I never did videos on. The last update I did was back in February, early March, I think. So this update is going to include the two new sectors. It was 3, but I eliminated one because it just didn't make sense. So I included casino and gambling REITs. To my knowledge, I only think there's like 3 or 4 actual REITs in this space. Vici Properties, MGM or MGP, and then GLI, which I'm not even sure what they stand for. But I know MGM is being acquired by Vici, VICI. And you can YouTube VICI or Vici Properties, and one of my more favorite investor analysts, Joseph Carlson. Look him up. He's a lover of this company. He actually recently interviewed the CEO of Vici Properties, and I thought it was a really good interview. So anyways, just shout out to him. He does really good work. He's the one who inspired me to pursue something similar in a similar fashion. So this is why the REIT portfolio was born, was passive income. But anyways, Vici Properties is in the casino and gambling REITs. Las Vegas, think of some, large casinos, things like that, leisure places. The last one is more of a high risk play. It is innovative industrial properties. IIPR is the stock ticker, and that is in the cannabis real estate sector. And I don't think there's many players in this sector. It's very spread out. Probably in the next couple of years there will be more, mergers and acquisitions and consolidations. So, but for now, IIPR is kind of my play. It's basically a REIT that purchases real estate and then leases it out to cannabis growers, producers, distribution centers, things like that deal specifically in cannabis. it's a high risk play, but they've been doing really well in the last couple of years, yeah, about 2 years now. They've been doing really well, and I can't see cannabis going away as more and more states start to adopt it and allow the legalization of cannabis or weed. It's a no-brainer at this point. This is more of a 5-10 year hold for me. So as you can see, that is a quick update and the background of the portfolio. Like I said, REITs have been overall in 2021, they've been doing really well, and that's mostly due to some macro factors. One, you have inflation that's going really high. I think the last time I checked it was at 6.8, 6.9%. So as inflation rises, so do, or in theory, wages are supposed to rise as well, right? Along with that, the rents are also going to rise, right? So all these companies are renting spaces, or all these REITs are renting spaces to tenants, right? So some of them are on short-term leases, long-term leases, or they have rent reviews built into their contracts, whatever have you, or the lease is renewed month to month, whatever. I don't know. For each of these individual ones, I can't tell you, but that is basically the basis behind real estate. Is you buy real estate and rent it out to tenants. So rents have been going up, inflation has been going up, real estate prices have been going up. So like single family homes, they've been going up like crazy. Institutions are buying them up, hedge funds are buying them up, individual investors are buying them up. Real estate's just been on a huge tear, right? So that was one of the macro factors that you have that contributed to REITs doing extremely well is inflation and inflation protection, right? A lot of investors are leaving the equities. I'm not going to say, that's a pretty broad statement, but a lot of investors are moving into REITs as inflation hedges, right? So another macro factor is COVID, right? We all know COVID. We're living in a post-coronavirus world. COVID's taken center stage across every nation, across every thing you could think of, right? So with REITs, real estate investment trusts, in the beginning, they took a huge nosedive, as did all equities, like everything in the S&P 500 index, almost every stock took a nosedive, right? But, the S&P 500 and all the companies in that recovered a lot quicker versus real estate because there was a lot of headwinds, a lot of unforeseen things, a lot of questions still lingering. Like apartments, they took a huge hit. More people are staying home, more people losing their jobs. The jobless claims were skyrocketing up. So, a lot of real estate companies took major hits, right? But as COVID vaccines were rolled out, as people were getting vaccinated, as the economy was beginning to reopening to a new normal, REITs have recovered and they've been doing really well since probably the beginning of 2021, late 2020. So I have no bad thing to say. I can't predict the future, but I know that REITs are going to do very well, or at least I feel that REITs will do very well in the next coming years. That is my prediction, and that's why I'm bullish on REITs, and I'm going to continue investing in this portfolio easily in the next coming years. So let's get down to the exciting piece that we're all kind of waiting on, is how did this portfolio perform against VNQ and perform against the S&P 500. So if we take a look right now at VNQ, we had a performance in the last year of 39.7%, right? So VNQ, the index, is comprised of, I think it's like 250 companies or so, or REITs. I keep saying companies. REITs, 250 REITs, or I think it's 230 plus REITs, 230, 250. I haven't looked in some time, but it's comprised of everything, right? It could have some garbage REITs. It could have lower quality REITs. It could have really good REITs. It could have the highest quality REITs, right? So it has a mix of everything. It is the total market of REITs, right? So the total market of REITs, the real estate index fund, returned 39.7%, which is really good when you think about it. Over 1 year, it returned almost 40%. So how did that compare against me, or how did I compare against the index? So I actually outperformed the Vanguard real estate index by almost 9%. So I have 48.78%. So I actually outperformed the index. Now, I just want to put this out there. past performance is not indicative of future performance, all right, or future gains, future profits, whatever you want to call it. This could have been just a luck of the draw. Maybe I invested at the right time, but we will see how the next 5 to 10 years plays out, because the indexes, they're the total market. They have historical data behind them, and VNQ has done exceptionally well. If I was to recommend anything as far as real estate REITs go, I would tell people just buy into an index. I'm wanted to take more of a active role in my portfolio, and that's why I selected the REITs that I selected. But for the average investor who wants to remain passive, not be reading, analysts, not be reading into the news, not get emotional about this or that or what have you, then just buy into an index, get the exposure to your overall portfolio. So I actually beat the index, which is cool. So let's take a look how I performed against the S&P 500. So the S&P 500 over the last year returned 28.62%. So again, I outperformed the S&P 500 index. But again, let me preface it with, past performance, etc., not indicative of future returns. So just because I beat it this year doesn't mean I will beat it consecutively over the next 10, 20, 30 years. Real estate could take a huge nosedive. Some of the REITs I'm invested into can go bankrupt, or get acquired by other companies or whatever. There's a lot that can happen in the next 10 to 20 years. Versus the index, which is a total market. I'm sorry, not a total market. It is a market cap weighted index of the 500 and 500 or 505 best companies. It's probably going to outperform me in the long term. So is what it is. But if we take a look over the last year between the two indexes, you will notice that VNQ actually outperformed the S&P 500 index, which I thought was really cool or really interesting. And again, it's the contributing factors is the macro things at play here. We have high inflation, low interest rates, right, and COVID still out and about. So that's just pretty much why real estate has been doing so well in the last year in a summary. So going back to this, this is my performance. The last time I did a video, I had like $22,000, almost $23,000 in the portfolio. So it's come along quite nicely. I'm hoping to get this portfolio, at least a cash investment, up to, I would say maybe like, 40,000, 45,000. So we'll see. I want to get this portfolio up to 100,000 in the next couple of years. So I'm hoping to do that, and then just again let it grow. These REITs that I'm invested in, there's nothing super sexy about them. There's nothing super exciting about them. They're not the next tech stock. They're not the next Amazon. They're not the next Tesla. They're not these super sexy REITs. This is real estate. Real estate is extremely slow. It's very boring. It's not going to make you rich overnight, right? So real estate has always been a long-term game, all right? Long-term game. You got to think, 5 years out plus, right? So a lot of these holdings, I'm expecting to hold them as long as possible. The one caveat that I'll put in this is that information changes, right? Companies or REITs get acquired, or REITs can fire the best management they ever had and then take a nosedive after. Or they can become over leveraged, which means that they're taking on way more debt than they have cash available, which is also a cause for concern. But these REITs that I'm invested in, I feel I can hold them for a long term. They're all great operators in their space. They're all great companies or REITs in their space. So I feel very safe, and I can sleep well at night knowing they're going to do well. I did have a third slice in there that I did not talk about, aside from the casino and the cannabis REITs, was the mortgage REITs. So I did invest into BXMT, which is Blackstone's mortgage trust. I wanted just to get some exposure, and I've been deciding if I wanted to add, a mortgage index or a mortgage, ETF to this fund or to this portfolio to get exposure to mortgages. And then after a while, I decided against it. I did buy into BMXT, and I ended up selling later on down the line, not at a gain, at a small little loss. But mortgage REITs, they're pretty they're pretty risky in my opinion. It's just you don't know how they're going to act. They're very sensitive to interest rates. They're very sensitive to how the government acts. They're very sensitive to just a lot of things. I'm not smart enough to really dive deep into the financials. I'm not smart enough to really follow them, and that's why I started leaning towards an ETF. But then I decided against the ETF only because expense ratio is going to be pretty high, and not only that, but taxes and tax efficiency just isn't there for me. So I decided against it. So that's the portfolio update for this last 6 months or for the last year. I think this portfolio performed really well. And again, I expect it to continue performing very well over the next couple of years. So if you guys like this video, or if you guys have questions, comments, or anything, please let me know down below in the comment section. I will post a link to this portfolio in the description. Some new additions, aside from the ones I didn't mention, like IIPR as well as Vici Properties. I did add a position of EXR, which is the Extra Space. I just haven't opened the position yet. I'm waiting for some more money to come in so I can invest in that company or that REIT. I also opened a position in Americold, which is a industrial REIT that focuses on cold storage, and it's based on the West Coast. Cold storage is very fragmented. There's really not a huge player in the space. As time goes on, I'm sure there'll be consolidations, mergers, acquisitions, that type of stuff. And I think Americold's probably going to be one of the bigger players in that space. At least that's my prediction. And this isn't me just, reading into financials and this and that. It's just me reading articles off the web. Seeking Alpha is probably one of the better ones. There's several authors on there that I follow. And just kind of reading about Americold. I think I don't have any exposure to, frozen storage, and, everyone's got to eat. So where do you think all that frozen food comes from, right? So that was just kind of my thought on the whole Americold thing. I don't think I opened up any other positions in any other sector. Yeah, I don't think so. Oh, Turno. I did open a position. Another industrial REIT is Turno, Turno Realty, TRNO. Again, another probably low to medium risk type of play. I think it'll do well over the long term. I don't really have a thesis to talk about yet. But in any case, guys, hope you guys liked the video. Please let me know what your thoughts are, questions, comments, concerns. And if you liked the video, thumbs up. If you hated it, thumbs down. All good. I'm starting to write more and more in my blog, letsmakeamill.com. And basically, I'm going to be doing more of an accountability series, but it'll be on that blog specifically, basically detailing week by week how I'm doing on my year plan. So thank you for watching. And again, let me know what you think down below in the comments.